When it comes to investing, looking out for stocks to avoid is just as important as selecting the right stocks to purchase. In recognizing the least preferable stocks out there, you'll be able to get an idea of what an ideal investment should be. And with that, you'll have an easier time looking for stocks to purchase when you're planning on investing this year. With that being said, here's a list of the not-so-great stocks that you might want to avoid investing in, so make sure to stick around till the end of the video. Hey, welcome to Stock Market Mate. Today we'll talk about the stocks that you should avoid buying this 2022. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Tesla. The first one on our list might come as a shock to some of you, but we think it's best to not invest in Tesla this year. Tesla Incorporated, ticker symbol TSLA, is one of the most famous automotive companies in America. Tesla manufactures electric vehicles, battery energy storage products ranging from home use to grid scale, solar panels, and solar roofing tiles, among other products and services. The stock is excessively expensive, and owning high-valued stocks such as this means you're going to be expecting less things to go wrong, which is very risky considering the supply chain in various industries. Furthermore, the cars will also be more expensive due to inflation, which potentially hurts demand, though margins will undoubtedly suffer if they refuse to raise prices. In addition, there has been a rumor going around of dissatisfaction with the supercharger network. Moreover, there's a growing need for some Tesla charging stations as more Teslas are on the road. There's also been the talk that Tesla is going to open up their charging stations to other electric vehicles soon, making it even worse for people who own Tesla cars, as it's going to be harder for them to quickly charge up when they need to. This will definitely be a bad thing for the stock or the company. With this valuation, there's simply too much to go right. The impact of any correction we might experience this year will greatly affect Tesla. Inovio Pharmaceuticals Incorporated. Next on the list is Inovio Pharmaceuticals Incorporated, and its ticker symbol is INO. Inovio is a biotechnology company that largely centers on the development of DNA medicines for diseases that are associated with human papillomavirus or HPV, as well as cancer and any infectious disease. Fun fact, during the first phase of the pandemic back in 2020, Inovio actually was the first company to claim to have made a vaccine for COVID-19 in, get this, just 3 hours, which is insane. And yet, do we have any Inovio vaccine right now? The answer is definitely no. Inovio has a bad reputation of claiming to have the solution whenever there's a disease problem in the world. They've claimed to have the solution to Ebola, Zika, and even the West Nile virus. Every disease that has the public worried is almost always followed by a press release from Inovio claiming they're on the case already. However, despite being around since the 1980s, the company has 0 drug or vaccines approved. That's 4 decades of not having a single product approved, which is a major red flag, so definitely beware of this company. The next time there's another disease that strikes, they might try to attract investors again by claiming to have worked on a cure, but then fail to actually have it approved. MicroStrategy. Lastly, another stock to definitely avoid is MicroStrategy Incorporated. Its ticker symbol is MSTR. MicroStrategy is a company in America that aims to provide business intelligence, mobile software, as well as cloud-based services. Moreover, it usually centers on buying Bitcoin, which some think it's quite strange if not completely weird. But yes, that's mostly the company's all about. They buy Bitcoin and hold it. If you think about it, that does sound rather less of a business model. MSTR currently trades as an agent for Bitcoin, which poses more volatility. Just last year, Bitcoin was down approximately 5%, and during that time, shares of MicroStrategy fell down 10%. Although if it's your will to own Bitcoin, then you can go ahead and buy Bitcoin. Just don't own the stock as it's not really much of a surrogate for Bitcoin, and on top of that, it certainly doesn't have much of a business model. More things to avoid. Before we wrap up today's video, here are some other things that investors must keep in mind to avoid when investing. It's normal to make a mistake as an investor. However, there are ways to avoid such mistakes, such as by recognizing them. This time we'll take a look at some of the most common mistakes that most investors make and should definitely take note of in order to avoid a big catastrophe later. Number 7. Lack of knowledge on the investment. Warren Buffett, one of the world's most successful investors, advises against investing in companies whose business models are unclear. In order to avoid this, the best thing to do is build a diversified portfolio of ETFs or exchange-traded funds. You can also opt for mutual funds if you fancy. However, in case you'd rather invest in individual stocks, just make sure to be thorough in understanding each of the companies which the stocks represent. Number 6. Looking too much at a company. It becomes so easy to fall in love with a company when we see it do well when we invest in them, but this often leads to us to forget that we bought the stock as an investment and to make money out of it. So should any of the fundamentals that prompted you to purchase the stock change, consider selling it. don't cling to it. Be wise and don't reject any of the warning signs that's telling you it's not safe for your portfolio anymore. Number 5. Not having enough patience. Growth of a portfolio should be gradual and steady to yield the best results. An investment portfolio should not be expected to perform other than its intended function. Otherwise, you'll be in for a lot of trouble. Meaning you need to check your expectations and keep it realistic. This means you need to keep your expectations realistic with regard to the timeline for portfolio growth and returns. Number 4. Too much investment turnover. Turnover, or jumping in and out of positions, destroys your return. It can be extremely expensive to do business if you aren't an institutional investor with low commission rates. There are also the short-term taxes rates and the opportunity cost of not making the most of long-term gains from other investments. So definitely avoid doing this if you don't want to be exposed to such risks. Number 3. Timing the market. Another thing that destroys returns is trying to time the market. Most have probably heard of this before, especially if you've been in the stock market for a while now. Nobody has ever been able to successfully time the market. It is just too difficult for any investor. Not even institutional investors have been able to pull it off. In a study conducted by Gary P. Brinson, L. Randolph Hood, and Gilbert L. B. Bauer titled Determinants of Portfolio Performance, Financial Analyst Journal 1986, addressed the returns of American pension funds. It was found that nearly 94% of the variation in results over time was explained by the decision to invest. To put it simply, your asset allocation decisions account for most of the return on your portfolio, not your timing or security selection. Number 2. Waiting to get even. This is another way to ensure you lose the profit that you've accumulated. Getting even means waiting until a loser's original cost basis has been reached before selling it. In behavioral finance, this is called a cognitive error. When you fail to recognize a loss, you're actually failing in 2 ways. First, they retain ownership of the losing stock, which may continue sliding until it's worthless. And second, those dollars could have been better spent if they were invested otherwise. Number 1. Failing to diversify. It may be possible to generate alpha in the form of excess returns over benchmarks by investing in a few concentrated positions, but common investors shouldn't make this mistake. It's so much better and wiser to stick to the principle of diversification. In order to build a diversified exchange-traded fund or ETF or mutual fund portfolio, you should allocate exposure to the major market segments. Likewise, in building an individual stock portfolio, make sure to include major sectors. The general rule is to make sure not to allocate more than 5% to 10% to a single investment. And that pretty much concludes the topic of this video. Once again, try to avoid investing in companies such as MicroStrategy, Novio, and Tesla this year. And above all, don't forget to avoid common investing mistakes so you won't have a problem in the long run. Well, that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!